Welcome to Griffonomics. Today is Wednesday, February 4th, 2026. I'm your host, and we have a really fascinating case study on the desk today. Now, for anyone new tuning in, here's the deal with our deep dives. We take a huge stack of sources earnings called transcripts, 10Ks, analyst reports, and we boil them all down. Basically, we read the boring financial documents so you don't have to.
It's the shortcut to being the smartest person in the room on your next coffee break.
Exactly. And today we're looking at a company that has gone through one of the most radical makeovers I've seen in the industrial world. Carlisle Companies, ticker CSL.
And the timing is, perfect. They just dropped their Q4 2025 earnings yesterday.
Which is great. But honestly, if you haven't looked at Carlisle in, say, 10 years, you probably wouldn't even recognize it today.
No, not at all.
That's where I want to start. Because if you rewind the clock a decade, Carlisle was what Wall Street politely calls a conglomerate.
Which is a nice way of saying they were having an identity crisis.
A big one. It was a grab bag. They were making brake systems for heavy trucks.
They were making those plastic food service trays you see in school cafeterias.
Right, and wire and cable for aerospace. And then, almost as an afterthought, they had a construction division.
It just sounds like a company that couldn't decide what it wanted to be when it grew up.
And that leads to what investors call the conglomerate discount.
Exactly. Think of it this way. If you go to a restaurant that serves sushi, pizza, and also changes tires in the back, you're probably not going to pay top dollar for the sushi.
You assume they aren't experts at any one thing.
And investors did the same. They penalized Carlisle's stock price because the business was just too messy.
So fast forward to today, February 2026. The brakes are gone, the cafeteria tray is gone, the wire is gone. What are we left with?
A pure-play building products powerhouse. They've stripped everything away to focus on one thing.
The building envelope.
The building envelope.
So not the thing I put a letter in.
No. In construction terms, the envelope is the skin of the building. It's the roof, the exterior walls, the waterproofing that goes into the foundation.
Basically, if it keeps the rain out and the air conditioning in, that's their domain now.
That is Carlisle's domain now, and the market loves that kind of clarity.
Why is that?
Well, pure-play companies usually trade at higher multiples because you know exactly what you're betting on. You're not buying a roofing company and accidentally inheriting a brake factory.
Okay, so the identity crisis is solved, but now we have to talk about the ambition. They've put out this roadmap called Vision 2030, and the headline number is startling. They are targeting $40 in earnings per share, EPS, by the year 2030.
Which is aggressive.
Yeah.
To give you some context, they just finished 2025 with about $19.40 in EPS.
So they want to double their profit in the next 5 years.
In simple terms, yeah. Double it.
That's the mission of this deep dive, then. We have to audit that number because I'm looking at the construction market headlines and things look shaky. Can they actually hit $40, or is this just corporate optimism colliding with a brick wall?
That is the multi-billion-dollar question. And the answer, I think, starts with the earnings report they just released.
Let's get into that, because I was reading the numbers this morning and I feel like I'm taking crazy pills. There's a paradox here.
The Q4 paradox.
Exactly. On one hand, their organic revenue is down. They sold 3% less stuff than they did a year ago.
Right.
But on the other hand, their earnings per share went up. They beat estimates by 32 cents. Came in at $3.90 when Wall Street expected $3.58.
It sounds backward, doesn't it?
It does. Usually when I sell less lemonade at my stand, I take home less money.
How did they pull a rabbit out of the hat here? Is this just accounting magic?
It's not magic, but it is a mix of financial engineering and extreme discipline. First, let's look at why revenue was down.
Okay.
The new construction market, so building new warehouses, new office parks, it was soft in late 2025. Interest rates did exactly what they were supposed to do. They slowed down development.
Okay, so fewer new buildings going up. That explains the revenue drop?
Yeah.
Right. But how do you beat earnings when sales are down? Two main levers. First, pricing power. Even though they sold fewer units, they didn't slash prices to chase volume. They held the line.
And the second?
Share buybacks. A lot of them.
We'll dive deeper into that later, but essentially they just reduced the number of slices in the pizza, so each remaining slice got more of the profit.
Precisely. But I want to be the buzzkill for a second. We can't just look at the EPS beat and say everything is perfect.
No.
No. If you look at the margins, specifically adjusted EBITDA, there was some pain.
I saw that. The margin fell from over 25% down to 22.1%. That's a 300 basis point drop. That seems significant.
It is, and this is a concept we need to unpack. operating leverage.
Break that down for us.
Imagine you own a massive factory that makes rubber roofing. You have to pay for the lights, the machinery, the staff, whether you make one roll of roofing or 10,000.
Right, fixed costs.
Exactly. When your volume drops like it did this quarter, those fixed costs eat up a larger percentage of every dollar you bring in.
Yeah.
You lose efficiency.
So a small drop in sales can lead to a bigger drop in profit margins.
That's it. The factory just wasn't running at full speed. But there's a second reason margins dropped. And this one is actually kind of good news.
How's that?
They front-loaded a ton of investment into R&D and innovation. They intentionally spent money now to protect that Vision 2030 later.
Okay, so they're taking a short-term hit to build a better engine. But despite all that, despite the margin drop, the soft revenue, there is one number that just screams stability.
The cash flow.
Yes. For the full year 2025, operating cash flow was over $1 billion.
And that's the fourth year in a row they've topped $1 billion.
This is what I struggle with. You just told me new construction is down. People aren't building new warehouses. How is this company printing $1 billion in cash if their main market is soft? Why aren't they crashing?
This brings us to the single most important concept for understanding Carlisle. If you take nothing else away from this deep dive, remember this statistic. 70% of what? 70% of their revenue in the main construction materials segment comes from re-roofing.
Not new buildings. Fixing old ones.
Correct. And here's why that matters. Let's say you're the CEO of a logistics company. The economy looks shaky. You can easily decide to cancel plans for a new distribution center.
Sure, you can delay it. It's discretionary spending.
But if the roof on your current warehouse springs a leak and water is dripping on your inventory, you cannot delay that. You don't call a board meeting to discuss the macro climate. You call a roofer immediately.
Because if you don't, you go out of business.
Exactly. It is non-discretionary demand. Rain doesn't care about interest rates. The weather doesn't care about the Federal Reserve.
That is a massive safety net.
And that net is getting stronger. Think about the building boom in the 90s and the early 2000s. All those commercial buildings are now hitting 20, 25 years old.
Which is the lifespan of a roof.
Pretty much. We are sitting on a ticking time bomb of aging infrastructure. The stat is that over 70% of U.S. commercial buildings are over 25 years old. Those roofs have to be replaced.
That's the floor under their stock price.
That's the floor.
Okay, that explains the defense. It explains why they don't collapse in a downturn. But you don't get to $40 EPS just by playing defense. You need growth. You need offense.
And that brings us back to Vision 2030. To double their earnings, they can't just rely on leaky roofs. They need to innovate.
This is where I want to get specific because innovation is such a corporate buzzword. Every company says they're innovative. What does that actually mean for a company that sells, well, sheets of rubber?
It's a fair question. It's not about putting microchips in the rubber. It's about solving the customer's actual problem.
And the customer's biggest problem is?
It's not the material. It's the labor.
Finding people to do the work.
Right. There's a massive shortage of skilled roofers. So Carlisle is pivoting from just selling materials to selling productivity. Take their new induction gun technology.
Which sounds like something from a sci-fi movie. What does it do?
Traditionally, adhering a roof is messy. You're rolling out glue, waiting for it to dry. These induction tools use magnetic energy to basically heat weld the membrane to plates underneath without penetrating the surface.
So it's faster.
Much faster. And it has temperature sensors built in to ensure a perfect bond every time. It reduces errors.
So it's foolproof.
More or less. But the key is speed. If a crew of 3 people with these guns can do the work of a crew of 5 people using the old method, the contractor saves a fortune in labor costs.
So Carlisle can charge a premium for the tool because it saves the contractor money on wages.
Exactly. They are selling speed. Another example is Thermathin 7.
Insulation.
High-performance insulation. Think about an old building in, say, New York City. You have these low parapet walls on the roof. Modern energy codes require really thick insulation, R30.
Okay.
If you use standard stuff, the roof ends up being taller than the wall, which is a code violation. Thermathin gives you that same high insulation value in a much thinner profile. It solves a geometry problem.
So they're solving these specific headaches for the people buying their stuff.
And they have a metric for this. They call it the freshness index. They want 25% of their revenue in 2030 to come from products that are less than 5 years old.
They're forcing themselves to invent new things.
They have to.
That all sounds great, but I have to play the skeptic again. We've talked about the cash cow, the commercial roofing business, but there's another part of this company, the growth engine.
You mean Carlisle Weatherproofing Technologies, or CWT?
Yes, this is the division that does spray foam waterproofing for houses. And frankly, looking at the numbers, this engine seems to be sputtering a bit.
It is the problem child right now, no doubt. In Q4, the margins for CWT were only 15.9%.
And what's the target for Vision 2030?
They need to get that over 25%.
Whoa, that is a massive gap. Going from what, basically 16% to 25% is not a small tweak.
It is nearly 1,000 basis points of expansion. And this, to me, is the biggest risk in that whole $40 EPS story. If they can't fix CWT, the math gets really, really hard.
So what's the plan? How do they fix it?
Two ways. First, they're applying what they call the Carlisle operating system to the CWT factories,
So taking the automation and efficiency secrets from the big roofing side and...
forcing them onto the weatherproofing side, teaching the little brother how to act like the big brother.
Okay, what's the second way?
The second factor is a bit out of their control. CWT is much more exposed to the residential housing market. They need people to be building new homes.
And if mortgage rates stay high...
Then the volume doesn't come back.
Yeah.
And if the volume doesn't come back, you don't get that operating leverage we talked about earlier. Your margins will stink no matter how automated your factory is.
So this is the show me part of the story. If you're listening to this and thinking about the stock, you have to watch those CWT margins like a hawk for the next few quarters.
Absolutely. That is where the battle for $40 EPS will be won or lost.
Let's shift gears to the money. We established they're generating over $1 billion in cash. They aren't building new factories every day. What are they doing with it all?
They are betting on themselves. The buyback program is incredibly aggressive.
I saw the number, $1.3 billion in share repurchases in 2025 alone.
And they just announced another $1 billion plan for 2026.
Why buybacks, though? Why not go out and buy a competitor?
Management was very candid about this on the call. They said the M&A market in 2025 was muted.
Which is code for?
It means sellers were delusional. Private equity firms and other owners wanted sky-high prices for their companies. Carlisle has a very strict financial discipline. They just refused to overpay.
So they looked at their own stock price.
And said, we're the best deal in town. Buying back your own stock when you think it's undervalued is the ultimate vote of confidence.
And for the income investors out there, we can't ignore the streak.
The dividend, 49 consecutive years of increases.
So next year is the big 5-0.
They're 1 year away from being crowned a dividend king.
Mm-hmm.
That is an elite club. Very few industrial companies have that kind of consistency.
So financially, they look bulletproof. Net debt to EBITDA is only 1.4x. They've got $1.1 billion in cash sitting on the balance sheet.
They have a fortress balance sheet. If the economy falls off a cliff in 2026, Carlisle isn't going bankrupt. In fact, a recession might actually help them.
How so?
Remember those delusional sellers asking for too much money? If the economy crashes, those prices come down. With $1.1 billion in cash, Carlisle could go on a shopping spree and pick up great assets for pennies on the dollar.
So heads they win, tails they also kind of win.
That's the idea.
Let's try to synthesize all of this. We have a pure play company with a massive moat in re-roofing, a paradoxical quarter where they made more money on less sales, a risky gap in the CWT margins, and a fortress balance sheet. What's the final verdict?
I view Carlisle as a quality compounder. I think of it in terms of a floor and a ceiling.
Walk me through that.
The floor is that re-roofing cycle. Because those buildings are old and rain is inevitable, the downside is protected. You aren't going to see revenue go to zero.
Okay, that's the floor. And the ceiling.
The ceiling is the recovery. Right now, the new construction and housing markets are asleep. Eventually, they will wake up. When they do, Carlisle gets a massive tailwind.
So you combine that recovery with the internal improvements they're trying to make.
In CWT, yeah. And you have a real path to significant upside. It's a defensive stock with offensive potential.
I saw one analyst summed it up as risk-defined, portfolio protected.
That's a perfect way to put it. Their outlook for 2026 is conservative. They're only predicting low single-digit growth. They aren't overpromising, but the machinery they're building under the hood is aggressive.
Before we sign off, I want to leave the listeners with a thought that struck me when you were describing those induction guns.
What's that?
We tend to think of Carlisle as a materials company. They sell rubber, plastic, foam. But if the demographics are true and the construction workforce keeps shrinking,
Which it is. The average age of a roofer is going up every year.
exactly, if the workers aren't there, then the value shifts. It shifts from the material itself to the method of installation. If Carlisle owns the proprietary tools, the induction guns, the peel and stick tech that make a job 30% faster, they stop being a materials company.
They become a productivity company.
Right. And does the company that owns the tools and efficiency become more valuable than the company that just owns the stuff?
That is a fascinating way to look at it. If they can successfully monetize that efficiency, that $40 EPS target might just be the starting point.
Something to mull over. We will be watching those CWT margins closely next quarter to see if that automation is actually working. Thanks for diving deep with us today.
Always a pleasure.
See you on the next deep dive.